Welcome to the Opening Bell Report.
Okay, it is Thursday, February 5th, 2026. And honestly, if you haven't checked your portfolio yet today, maybe just don't.
Right. Yeah. Keep the app closed. Go for a walk.
Seriously, because it is ugly out there. But there's one name in particular that is just absolutely taking it on the chin, and that's Robinhood Markets, ticker symbol HOOD.
It's a bloodbath. I mean, there's really no other way to describe it.
I'm looking at the live quote right now, and it's painful. The stock is down 9.85% just today.
Just in this session.
And if you zoom out to the monthly view, it's horrific. We're talking about a 41% drop in the last 30 days. It's sitting at, what, $72.68?
Which, for anyone who bought in during that January rally, it just feels like the floor completely dissolved beneath their feet.
It looks like an absolute disaster. You'd glance at the chart and think the company was, I don't know, broken or about to announce some catastrophic fine.
Right.
But, and this is why we do these deep dives, we got our hands on a brand new analysis report. It's from the Gemini Financial Intelligence Unit.
And it's dated for tomorrow, actually, February 6th.
So we're getting a sneak peek. And the report uses a very specific, I'd say a very loaded word to describe what's happening right now.
Dislocation.
Dislocation. That's the mission for today. We need to figure out if this is actually a dislocation, where the price just breaks away from reality, or if the market is correctly pricing in some kind of disaster we can't see.
Because the numbers just don't seem to line up with the price action.
Not at all. I was reading through the summary, and the central mystery here is genuinely confusing. How does a company double its revenue, triple its net income, and yet see its stock price get cut in half in 4 weeks?
It defies basic logic, doesn't it? I mean, in a so-called efficient market, if you make more money, your stock is supposed to go up.
Right.
But markets aren't always efficient. They're emotional.
So that's what we're going to do. We're going to unpack this Gemini report piece by piece. We need to look at the new Robinhood business model because I think a lot of people still have the 2021 version stuck in their heads.
Sure.
We're going to dig into what the report calls a hidden number that jumped out at me in the valuation section, the PEG ratio.
Oh, yeah. That part is critical.
And we have to answer the big question. Is this just a falling knife that's going to cut your hand off, or is it the sale of the decade?
And to really get to that, we have to start with the narrative because stocks, they move on stories just as much as they move on math.
Okay, good point. So what's the story Wall Street is telling itself right now? Why all the panic?
Well, the market has a bit of PTSD when it comes to Robinhood. Wall Street looks at Hood, and they don't see a mature financial institution.
They see 2021.
They see 2021. They see GameStop. They see Dogecoin. They see a casino.
The meme stock era. I think we all remember where we were when GameStop went to the moon.
Exactly. So right now we're seeing this broader tech rotation, and there are some fears about a crypto winter coming back. So when those headlines hit, the algorithms just dump Robinhood automatically.
So it's just a proxy for risk.
It's a high beta proxy for retail gambling. If the market gets scared, they sell the risky app first.
But that's the disconnect the report highlights, isn't it? I was looking at the section on their product evolution, and it seems like the company realized, back in 2023, that they couldn't just survive on trading fees. They've pivoted.
It's a massive pivot. I mean, they've moved from being a trading app to what analysts are calling a neo-broker or a financial super app.
The super app. Okay, it's a buzzword, but let's drill down. What does that actually look like in 2026? Because I saw the note about IRAs, and that caught my attention.
This is critical.
Yeah.
A couple of years ago, Robinhood launched retirement accounts, IRAs, with a matching contribution.
Right.
At the time, people thought, it's just a marketing gimmick. But think about the stickiness of that.
Well, yeah. I mean, if I move my retirement account there to get a 3% match, I'm not day-trading that money. That's sticky capital.
Yeah, precisely. And it's not just the match. It's the credit card integrated into the account. It's the high-yield cash management. They've built an ecosystem where your paycheck can hit the account, earn interest, pay your bills, and fund your retirement.
So they're competing with Chase now, not just E-Trade.
They're competing with Bank of America, not just Interactive Brokers.
But I have to play the skeptic here. Offering a 3% match on an IRA contribution, that sounds expensive. Isn't that just burning cash to buy growth? It sounds like the old growth at all costs model that usually ends in tears.
And that's a fair pushback. The street was worried about that cost initially.
Yeah.
But where that super app strategy really pays off.
How so?
The payback period on those customers is incredibly short. Because once they're in the ecosystem, they cross-pollinate, they start using margin, they subscribe to Robinhood Gold, they trade a little crypto. The lifetime value of these customers is just skyrocketing.
Okay, so that justifies the upfront cost. The product is stickier. They aren't just relying on bored people trading options on their lunch break.
Not anymore.
But let's look at the actual scorecard. You can have the best app in the world, but if you aren't making money, the stock drop is justified. The report lists the Q3 2025 stats. Are they actually printing cash?
Printing might be an understatement. The numbers in this report are, frankly, staggering, especially when you put them next to the stock chart.
Okay, walk us through the headlines.
So total net revenue came in at $1.27 billion.
Wow, $1.27 billion for the quarter. For context, what's the growth rate on that?
That's up 100% year over year.
100. They literally doubled their revenue.
Doubled it in a macro environment where everyone is worried about a slowdown.
That's insane.
Yes. But usually, high growth comes with high losses. That's the standard tech trade-off. But look at the bottom line. Net income, it surged 270% to over $550 million.
Wait, pause on that. $550 million in profit.
In one quarter.
Mm-hmm.
And their earnings per share, their EPS, is 61 cents. That's up 259%.
So let me just make sure I'm not taking crazy pills here.
Yeah, lay it out.
The stock price, the thing we pay to own a piece of this future cash flow, is down 41% this month.
Nice.
But
Yeah.
the actual cash flow per share has nearly tripled.
That is the definition of a dislocation. You have the fundamental business metrics exploding to the upside, profitability, cash, user growth, while the sentiment-driven price is just collapsing
The two lines are moving in opposite directions.
completely.
Which brings us to valuation. I want to spend some real time here because this is where the report gets really interesting. There's a section titled "The Number Wall Street Missed," and it focuses on the PEG ratio.
Yes.
Now, I know our listeners are smart. They know what a PE ratio is, but the PEG ratio is a little more nuanced.
It is, but it's probably the most important metric for a growth stock. The price-to-earnings ratio, the PE, it just tells you how expensive a stock is today. It doesn't account for speed.
Right. It's like looking at the speedometer but ignoring the acceleration.
Perfect analogy. A company growing at 5% shouldn't have the same PE as a company growing at 50%. So the PEG ratio fixes this. It divides the PE by the growth rate.
PE divided by growth. And the rule of thumb is that 1.0 is fair value, right?
Correct. A PEG of 1.0 means you're paying a fair price for the growth. If it's 2.0, it's expensive. Below 1.0, it's cheap. And if you see a PEG of, say, 0.3, that's usually a mistake in the data, or a sign a company's in real trouble. It's dirt cheap.
Okay, so let's look at the comps in the report. How does Hood stack up against the big boys?
So they do, but the valuations are vastly different. Let's start with Charles Schwab, SCHW. It's the gold standard. Schwab trades at a PE of about 22x, and their growth rate is roughly 22%.
So 22 divided by 22, that's a PEG of 1 point.
Exactly. Efficiently priced. You pay a premium, you get steady growth. Now look at Interactive Brokers, IBKR. Their PE is about 31x. Growth is 22%, so their PEG is around 1.4.
Okay, so a bit pricey. You're paying more for the same growth rate as Schwab.
Right. Now look at Robinhood. Its PE is roughly 30x.
Okay, so on the surface, just looking at PE, Robinhood looks just as expensive as Interactive Brokers, 30x versus 31x. I can see why an algorithm would say, well, it's not cheap.
And that is the trap. That's what everyone is missing. You have to look at the denominator.
The growth rate.
Schwab and Interactive Brokers are growing at 22%.
Yeah.
Robinhood is growing at 100%.
And that's a wild card.
So you take that 30x PE and you divide it by 100, and that gives you a PEG ratio of 0.3.
0.3.
And the report even notes that if you use trailing 12-month metrics, it might be as low as a BO.2.
That is absurd. I mean, mathematically, that implies the market thinks the growth is going to stop tomorrow, dead in its tracks.
Or it implies the market is just completely ignoring it.
Yeah.
To use an analogy, it's like going to a car dealership. You've got a Honda Civic priced at $25,000, and right next to it, there's a brand new Ferrari, also priced at $25,000.
Because the dealer thinks the Ferrari might run out of gas in a mile.
Or because the dealer remembers that Ferraris used to be dangerous to drive. They're pricing the asset based on its past reputation, not its current performance. You're getting 4 times the growth speed for the same earnings multiple.
Okay, I love the Ferrari analogy, but I have to be the responsible driver here. You don't get a PEG of 0.3 without some hair on it. There has to be a reason the market is discounting this growth. Is it possible that this 100% growth is a fluke? A momentary spike?
That is the bear case, and we have to take it seriously. The market is pricing in a collapsing growth. They're worried that if we hit a crypto winter or a recession, trading volumes will just dry up.
And we saw that happen in 2022. The stock imploded because the revenue evaporated.
We did. But this brings us back to the new Robinhood model. The report calls this next section the safety net.
And the safety net is the subscription revenue.
Yes, Robinhood Gold. This didn't exist at this kind of scale back in 2022. We're now talking about 3.9 million Gold subscribers.
3.9 million people.
And these are people paying a monthly fee, rain or shine, bull market or bear market, to access the platform's features.
That's a lot of recurring revenue. Hundreds of millions of dollars.
It's massive, and it's crucial. That recurring revenue covers a huge portion of their fixed costs, their servers, their engineers, their rent.
So unlike 2022, they don't need a frenzy of trading just to keep the lights on.
Exactly. They've built a floor. Even if trading volume goes to zero, which, it won't, the subscription fees and the interest on cash deposits keep the company solvent. They won't spiral into massive losses again.
Speaking of deposits, that was another number that really stood out to me. Sentiment is terrible, right? People are dumping the stock. But are users actually leaving the platform?
That is the ultimate litmus test. Sentiment versus reality. The stock is down 41%, but net deposits, the actual cash users are bringing in, are growing at a 29% annualized rate.
So the customers aren't scared?
Not at all. In the third quarter alone, users added $20 billion to the platform.
$20 billion!
3 months. Think about that. While hedge funds are dumping the stock, the actual users are trusting the platform with $20 billion of fresh capital. There's no churn. Users are not leaving. The business engine is humming along perfectly. The dislocation is strictly in the share price.
That is such a stark contrast. It just highlights how disconnected the stock market can be from the real economy sometimes.
Absolutely.
But let's talk timing. Because as compelling as the business case is, you never want to catch a falling knife.
No, and the chart right now is ugly. It's a waterfall decline, no doubt about it.
The report mentions the technical setup. For the folks who care about the charts, what are we looking at? Is there a bottom in sight?
Well, first, the warning. The bear case is tied to Bitcoin. Robinhood stock still has a very high correlation to crypto prices.
Right.
So if Bitcoin breaks its key support levels, the algos will likely drag it down with it. The report warns it could test $50 in a worst-case scenario. Ouch.
$50. That's another, 30% drop from here? That's not insignificant.
It's the risk you take. But now look at the bullish indicators. The RSI, the Relative Strength Index, is sitting between 20 and 25.
And I know oversold is usually 30. So what does 20 even mean for a company like this?
It means extreme oversold. I mean, we rarely see an RSI of 20 on a profitable large-cap company. We haven't seen readings like this since maybe the Meta crash of 2022.
And we all know how that turned out. Meta rallied like crazy afterward.
Exactly. Statistically, when that rubber band is stretched this far, it tends to snap back violently. The selling pressure just exhausts itself.
What about the smart money? Are institutions buying this dip, or are they running for the hills too?
The report suggests there are massive institutional buy orders, likely sitting in the $68 to $70 range.
Which is right where we are.
We are sitting right on top of major support. This was a breakout level from back in 2024. You know the saying, old resistance becomes new support.
Okay, and what are the analysts saying? The people whose job it is to put a price tag on this thing.
Surprisingly, they're holding the line. Bernstein reiterated an outperform rating just 2 days ago, on February 3rd. Their target is $160.
$160, and we're trading at 72.
That's more than 100% upside. And Zacks has it ranked as a strong buy, their #1 rank. So the consensus on the street, among the humans anyway, is that this price is wrong.
Okay, so let's try to pull all of this together. We've covered a lot of ground here, from the super app pivot to the PEG ratio math. If you had to summarize this dislocation thesis for someone standing in an elevator, what's the pitch?
I'd say this. You're looking at a company with roughly 50% net margins. It's growing revenue at 100%, and yet it's trading at a distressed price.
But the distress is fake.
The distress is emotional. It's based on market mood, not business mechanics. The business is healthier than it has ever been. Wall Street is throwing the baby out with the bathwater, and they're throwing out the golden tub, that subscription revenue along with it.
I like that, the golden tub. It really drives home the value of that recurring revenue.
It's the safety net. It's what makes this time so different from 2021.
So before we sign off, I want to leave the listener with one final thought. We've looked at the bull case, we've looked at the bear case, but what's the one question they should ask themselves before they decide to buy, sell, or hold?
Go back to that PEG ratio. It's below 0.5. In the modern stock market, you usually have to pay a massive premium for growth. If you want NVIDIA-style growth, you have to pay NVIDIA-style multiples.
You pay for quality.
You pay for quality, exactly. But here, the market is basically handing you a monopoly on growth, literally doubling revenue for the price of a boring, low-growth utility company. So the provocative thought is this. Is the market just wrong? Is this a massive inefficiency created by fear?
Whoa.
Or is there a crypto risk lurking in the shadows that the algorithms can see, but we can't?
That is the million-dollar question. Is it a trap or is it a gift?
The math says it's a gift. The chart says it's a falling knife. You have to decide which one you trust more.
Well, I know what I'm going to be looking at for the rest of the day. For everyone listening, if you want to see the charts, the PEG calculations, and the full breakdown of that $1.27 billion revenue number, check the show notes. We've linked the analysis report there.
It is definitely worth a read.
It absolutely is. Thank you for diving deep with us on this crazy Thursday. Try not to stare at the red numbers too long. Remember, volatility creates opportunity. We'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.